You know, there's a strange thing happening in the world right now, as usual, but more so now, as markets are telling us everything is fine. Governments are telling us that the monetary system is fine. And yet underneath the surface, some of the world's largest players seem to quietly be preparing for a world in which the existing system just might not be enough. So the question today isn't, is the dollar going to collapse? The question is, what if the world is already building the system that comes after it? And most people haven't noticed. I believe my guest today has noticed it. If someone only looked at the S&P 500, Francis, and the headlines, you know, like a lot of people I know, they'd probably conclude everything is just fine. What are they not seeing, man? What do you think they're missing?
What they're seeing is a crowding out situation. In fact, the whole world, there's a two-tier world at the moment. And there's a certain part, the S&P 500 is dominated. We don't have a Nifty 50 anymore. We sort of have a Nifty 15, of which we have the Mag 7 in there. And we've had a crowding out. I refer to it as our twisted balloon economy. We sort of twist the balloon like the clown that does the dog for the kids. And all the air has gone into one half of the balloon. One part is called Main Street, and the other is sort of the tech Wall Street hyperscaling game. And that's where we're getting hypervaluations and excess liquidity is all gathering. But if you're running an SME and are a small business or enterprise, and you're trying to get credit for 10 grand overdraft or maybe 50 or 100, that's really hard to get. But the big unicorns borrow billions and they get access to it until recently rather well. However, recently, and I do feel that that's turning, Andy, even the big unicorns' debt instruments are being balked at now if they start to issue. Their cash generative nature and their scale no longer is impressing in terms of that part of the world, which is what's crowded the S&P out like it has. And I think we have a hypervaluation in assets. And I'll also point my favorite valuation, which I tend to usually do with charts. You can let me know if you want me to take you there, is to divide by the gold ounce. And in actual fact, we're having an everything depreciating, that we are actually having a deflation. We're having a deflation of property. We're having a deflation of most things. In terms of certainly the M2 money supply and gold. If you include those two as your benchmarks, most things are actually deflating.
Yeah, that's an important point. Feel free to show your charts at any time, and that's one of my favorite metrics is that assets are going higher in dollars and falling precipitously in ounces of gold. One point that I think is very important to make. You know, we hear a lot about these days about this Japanese yen carry trade and the ramifications of a rising yen or of a falling yen or of rising treasury yields or of rising yields in Japan. And I don't think a lot of people really quite grasp it. So forget the debt number for a minute and walk me through the machine, because if Japan has to choose between defending the yen and protecting its own government bond market, while the United States is simultaneously trying to protect the U.S. Treasury market, and now you have Scott Bessent, Treasury Secretary, intervening in the yen, what is actually being protected here, and where does the pressure ultimately go?
That's such a good quality question. And there's what they tell you. So I always say we live in a duality world. There's a duality of morality, in fact. The insiders talk honestly to each other, and then they perpetuate a different narrative. Those that have just been following the Fauci revelations will know that he says one thing inside, and then he inverts it for everybody else. So in the same way, in the financial sense, we have that. They don't want to scare the herd, but behind they might be panicking, and they're telling you, stay calm, carry on. So in this Bessent Japanese yen story, which is current and very interesting, we clearly had a devaluing yen. And once it was past the 162 and going higher, this is a major problem. In fact, in the previous 18 months, rice, a staple obviously in Japan, had virtually doubled. And that's a debasement of currency. So no doubt they wanted to act on that. And my suspicion, and I think it was the number mooted was around 58 billion in treasuries were sought to be sold by the Japanese. And what that led to is we saw the 30-year, the 10-year, all the rates rising, in other words, the debt devaluing. And simultaneously, we also, and this hits the dollar milkshake guys really hard in the belly, the dollar was also falling. So if we're having a repatriation back to Japan, if that was the crisis, they would sell the treasury, they would convert, they would get dollars, they would convert from dollars back to yen, and we got the spike in the yen that saw the USD JPY dip down. If that was the process, it caused quite clearly a panic, and there were no doubt conversations. And what transpired is, hey, don't sell that. We can let you lend against that. And what that actually means is I become a borrower from you, Andy, even though you're holding my $1.1 trillion. And it shouldn't be that way, that I have to come and beg for terms from you. It's supposed to be a liquid asset. The 1 year to 30 years is a 24 trillion market by market cap. And these guys were looking to sell 58 billion. That's kind of me looking for $58 payment on the $24,000 you owe me. And you're saying, no, you're going to bust me with that. It shouldn't happen. And this is the illusion of market cap. You have a market cap at 24 trillion, but in actual fact, it's not that very well endorsed with high volumes of buying and selling. There's an asymmetry. There's always facilitation for buying. There's, the Chinese have their own computer system for buying treasuries. Everyone's very well served for buying. But if you come to a point where you want to be as a major player, a seller, I call it the Hotel California UST position. You can check out anytime you like, but you can never leave. You're a big player. You're a big holder. I'm sorry. You're part of it's now your problem. It's no longer America's problem. And I think Japan found out a little bit about that conundrum. Let you come back to me.
Yeah, I mean, are we at the point right now, and I agree with you, and that is a very well explained answer, articulated. I think people can understand that. So I guess if what I'm hearing you say, are we at the point where now this debt problem stops being a government problem and more actually becomes a collateral problem?
The debt problem actually becomes everybody who's a owner of the asset problem, including America. So whilst it's an American problem, it's also all those that hold American debts problem, which is what the Japanese are busy finding out. In short, they can't get their money back. There isn't that liquidity. And lest we forget and only talk about America, a lot of other nations, mainly first world Western nations, have perpetuated their own versions of this. So even the EU are putting out repo. I want to give you 4 examples, actually, just on this checkout anytime you like, but you can never leave, just to drill a little harder on this. You had the Californian Teachers Association that couldn't make a payroll, and they wanted to sell. Quickly, everyone like on the phone, what are you doing? Crashing the market, selling bonds? Hey, we'll let you get a lending against that. That's one of the largest pension funds in the US. We had the Gulf states during Straits of Hormuz. What happened there? Well, they lost all their tourism. They got oil supply bombed. They weren't making any revenue. They got hotels in the desert with no tourists. They wanted to sell some treasuries. Whoa, swap lines. Here we go. Hey, have all you need. There we go. We'll sort you out. Don't touch that stuff. No. Here's a swap line. And of course, we had the British version, which is an example as a microcosm. When they couldn't make pensions, there was a big seller. No, my apologies. Liz Truss was the story. She was the shortest prime minister, literally didn't make 6 weeks, along with Kwasi Kwarteng. And they wanted to do a stimulus budget to try get growth going. And that meant they were going to issue more bonds and they weren't going to pass on tax increases to try to stimulate the economy. I actually think that wasn't a bad idea, but let's just pause on that. The market balked at more issuance of gilts. What happened? Currency went down and the debt went down. And I referenced the whole dollar milkshakey thing. We win even though it's the rest of the world's problem and all of that. What we actually seen, Andy, is in the last 2 weeks, the debt markets went down, rates went up, 30-year, 10-year, go see, and we can show you those charts. But the dollar also went down. That's distress. That's distress, and that's what happened to the pound in the Liz Truss moment. And you've now had, and I said that's a microcosm at the time, America will have a similar moment. Now we are having very much a smaller, not a full-blown crisis, but a little bit of a tremor, a pre-earthquake tremor. And you are seeing that in actual fact, rates going up in the treasury market when it's in an unhealthy distress way is not leading to global funds all dying to be in bonds and treasuries. And the reason for that is the 2020 was a bond turn. In nominal terms, bonds do not go up anymore. They are no longer deemed risk-free. And we really turned the circle. You know, we jumped the shark with that CV19, and we're on the other side of the pond now. And it's a very different. And everyone goes, no, they can just print, they can just issue. No, because there's no buyers. And when there's no buyers and people don't want, rates go up and valuations have to go down. And that's the big difference. A lot of people seem to be missing this point. We turned a corner in 2020. And this, of course, comes back to gold as preservation. Its return of capital is, as Rick Rule and many others who use the phrase, rather than return on. It almost doesn't matter what yields can be because you will overshoot in a contagion of collapse. Nobody wants to hold it. It doesn't matter if you're getting paid a high interest rate, if you're not getting the capital back. And I think that moment's coming. And I think, like you mentioned in your very good opening statement, people behind the scenes are shifting around the deck chairs on this Titanic for positioning closer to the lifeboats.
Yeah, that's just it. In a rising interest rate environment with the world reserve currency, if all was okay, that would usually be associated with a strong economy and money flowing to capture those high interest rates.
A stronger dollar. Yeah.
It's the opposite right now. It's about trust. And look at, I don't know if it's related or not, the corollary effects. You look at the redemptions that were attempted in private equity last year. That were blocked and gated, and you look at all of these valuations in a low interest rate environment that created these distortions, and now people, as rates are moving higher, trying to get out. Well, oh no, that you can't do that. This is going to collapse the system. It's interesting that the heads of credit at BlackRock and Blackstone, as an aside, both resigned a week and a half ago. I think that's what we're seeing, whether it be on a government level and even in a market level, these distortions. Since you mentioned gold, I would like to chat about that, but that's going to be a little bit down the road here. I want to ask you a couple other questions before we get there. When we look at what the global South is preparing for, and I know that you talk about this a lot, when you look at countries across the global South that are building these alternative payment rails and settlement systems, like we see in Hong Kong, settling metals in yuan same day, expanding bilateral trade over things like mBridge and SIPs and whatnot, and the increasingly emphasizing physical settlement in gold and silver. What do you make of it? What do you think they're really preparing for? I guess is my question. Not so much to displace the dollar, or is it more along lines of building a parallel system? What do you think they're preparing for by setting up these systems and accumulating the commodities the way they are?
I think you mentioned such a key word in the question almost, and you're paraphrasing just before it, and that's trust. So what we're actually witnessing is a loss of trust in the westernized debt fiat-based system. And what you're seeing is other parties reconstructing a system that will be of higher trust, that will automatically win the votes of the masses in due course. And aspiring, and the new always aspires to be good. It takes a while before established systems start to pervert and cut corners. Initially, they come into business and to compete to be better. And that's the part where they're adding value. That's the part where they're saying, we will be more trustworthy than them. you and I enter the chocolate business and we say, we're not going to do the corn syrup. We're going to have proper cacao, none of this Frankenstein lab stuff. We want people to feel good, they love our products and see all of that. And then later we get fat and lazy and we compromise our morals and we trim and we want to make more profit and we don't love it quite as much. That tends to be the cycle. We're too principled to go that route, Andy, I'm pretty sure. But unfortunately, political systems do tend to go through that cycle. I think you're going to get a higher trust-based system based off of localized vaulting, as you've already described, coming up out of the East, and that it will siphon away a lot of the true wealth, and people will feel more comfortable in a trade-based system like that, and citizens will. I do also fear, though, that generally the concept and principle of tokenization is coming for gold as well. And my personal opinion is you should probably consider how much of yours you go and tokenize in lieu of many unrealized capital gain taxes and other attack vectors that are likely to come. Because if hardship awaits, government and dark state tends to see the citizens as the marks for funding. And as we've already seen, as I mentioned with the Fauci revelations, your health, your wealth are your responsibilities. And, the bigger systems aren't always that candid in giving you the best advice for overseeing those. So the trust needs to return. And I think in all these instances, these are attempts to regain trust, both in the revelations, like we're arcing back to truth with what happened over 19, and in money with China going the gold vaulting and knowing that gold is fundamental to trust. Deep down, you and I both know gold is money and everything else is credit. And I think the smart minds know that they've got to win that game and establish that credit, that real money for any form of trade system to have the same trust or better trust than the failing one that we're busy witnessing.
Yeah, there's no question gold is becoming tokenized. I can tell you, I know this to be true. My feeling is that it's moving more towards the institutional to challenge the ETF market, redeemability, transparency, the ability to post for collateral, all of these things you don't get with the ETFs, plus you're paying BlackRock and JP Morgan a 50 basis point management fee. I do think tokenization is coming.